Okay, let's jump right into this explainer. When we think about the AI revolution, our minds usually go straight to sleek algorithms and this invisible cloud. But actually, that cloud is made of thousands of massive physical servers. And let me tell you, they are incredibly power-hungry. So today, we're unpacking FirstEnergy's Q2 2026 strategic update to see exactly how a legacy power utility is pivoting to fuel this massive modern tech explosion.
To really grasp this, we've got to ask ourselves a pretty fundamental question. How in the world does traditional physical grid infrastructure possibly keep up with the insatiable, rapidly growing energy demands of artificial intelligence and cloud computing? Honestly, it's a colossal engineering and financial challenge. We are witnessing this historic collision between heavy industry and cutting-edge tech. And utility companies, well, they're suddenly sitting right at the absolute center of the AI revolution.
Section 1. The data center boom.
So, 24.8 gigawatts. That staggering number represents FirstEnergy's total pipeline and contracted data center demand. To put that into perspective, just a single gigawatt can power roughly 750,000 homes. And this 30% spike we're seeing since just the first quarter of 2026, yeah, that isn't slow, steady growth. It's an absolute tidal wave from tech companies who are just desperate to build out the infrastructure required for the next generation of computing.
And if we narrow it down to actual signed contracts with these tech giants, we're sitting at 6.4 gigawatts. That is a massive 50% jump since Q1 alone. But here's the wildest part. FirstEnergy expects another 1.5 gigawatts to be locked in over the next 2 weeks. 2 weeks! This super aggressive pace of closing contracts just proves how frantically these data centers are working to secure their lifelines.
Now, this explosive growth is hyper-concentrated geographically. By 2035, projected total demand in Ohio absolutely explodes to over 8,500 megawatts, with Pennsylvania right behind it at nearly 5,400. We are literally watching a regional transformation happen in real time, pulling the entire economic center of gravity toward these states to support America's digital backbone.
It is so crucial to remember that behind the cloud are massive steel transmission towers, high voltage lines, and heavy machinery. FirstEnergy notes a general rule of thumb here that is absolutely critical to understand. It takes roughly $250 million in transmission network upgrades for every single gigawatt of power. So when we talk about gigawatts of new demand, we are simultaneously talking about billions of dollars in physical construction and grid modernization.
Section 2. The West Virginia Strategy.
Zooming in on West Virginia for a second, the state has quickly amassed a massive 4.3 gigawatts in localized data center demand. Because of this heavily concentrated spike, FirstEnergy has a really unique opportunity on their hands. Instead of just moving power around, they can actually build entirely new generation facilities from scratch.
To manage all this massive localized growth, they're evaluating investments based strictly on 4 core principles. The main challenge here? Bringing new generation online at the speed of tech, but without hiking up costs for everyday existing customers. It's a real high-wire balancing act. They have to please the tech giants, protect local households, support broader economic growth, and of course, deliver appropriate market-based returns to their investors.
Section 3. Q2 Financial Performance. Looking at the hard numbers, they delivered a solid Q2 core earnings per share of 50 cents, bringing the year-to-date total to $1.22. That puts them perfectly on track to hit their annual targets of $2.62 to $2.82. In a tech sector that is currently experiencing unprecedented, somewhat chaotic growth, this kind of boring, reliable financial stability from a foundational partner is exactly what Wall Street wants to see.
The main story this quarter, though, is a deliberate trade-off. See, they have steady revenue coming from their rate base, which simply refers to the physical assets they use to provide power. But that growth is being temporarily offset by carefully planned, heavy maintenance expenses. Essentially, they are actively choosing to spend money now to future-proof the grid, taking a small hit today for a much bigger, much more resilient payoff tomorrow.
And let's be totally clear, this $6 billion capital deployment for the year isn't just some spreadsheet entry. It funds hard physical work on the lines. In fact, it has already driven a 12% year-over-year drop in SAIDI. If you're not familiar, that's the industry metric for how long customers actually sit in the dark during a power outage. So this money is quite literally keeping the lights on.
Section 4. Advancing Regulatory Strategies.
Because FirstEnergy operates across a bunch of diverse jurisdictions, they have to navigate a pretty complex web of state regulations. We're talking moving from West Virginia's inflation orders to upcoming base rate filings in New Jersey and Maryland. But this diversity actually gives them crucial flexibility to adjust capital deployment as different state environments evolve. Basically, if one state's regulatory process bogs down, they can just shift their focus and resources to another.
Section 5. The long-term vision.
The foundation of their future is this immense $36 billion investment plan stretching out through 2030. This capital unlocks massive potential, driving a steady 10% compounding annual growth in their core physical assets. Plus, this positions them to deliver earnings growth right near the top end of their 6 to 8% target range. They are effectively turning the unpredictable AI boom into a highly predictable, highly profitable physical build-out.
There's a quote straight from their earnings presentation that completely reveals their true mindset here. FirstEnergy isn't just reacting to AI. They're actively positioning themselves as the critical, foundational layer required for it to even exist. They don't see the massive energy demand of data centers as a burden on the grid. No, they see it as a historic gold rush for investment and regional economic development.
So, as the lines between rusty physical infrastructure and high-tech innovation continue to blur, the race is officially on. The cloud requires iron, steel, and massive amounts of electricity. The question isn't just which tech companies will win the AI race anymore. It's which legacy utility companies will have the foresight to power it. Thank you so much for joining me on this explainer, and we'll catch you next time.